few trends that we're seeing impacting not only the local market but the wider Auckland market, and indeed I'm going to start off with some international trends because that's having a big impact on our commercial market. As you may know, we've been selling down the latest of the Augusta syndicated products, an office block in Parnell, and as a result of that we were doing some background research for the guys on the inflow of overseas funds into commercial property, and it was actually quite interesting, more significant than we had imagined before we did it. So I'll just start off actually with some comments around that. And I think look, when people are looking to invest, they're looking for a couple of things. They're looking for security, and they're looking for obviously the return profile that they want to achieve for their money. And with regards to security, I think on an almost weekly basis now, New Zealand looks like a better and better option, doesn't it? If we look at some of the events that have occurred and are occurring around the world over the last couple of years or so, particularly since Mr. Trump was elected, chaos seems to escalate on an almost weekly basis. At the moment, of course, he's escalating rhetoric around trade wars with the Chinese, with the Europeans, with the Canadians, etc. And that causes uncertainty in marketplaces, it causes uncertainty in economies, and of course that gets reflected in the pricing of all assets as a result of that. Meanwhile, the Russians are killing people on the streets of Britain, the Americans are disjunct with them, the Chinese are militarising the South China Sea, so there's all sorts of geopolitical issues, which of course you would hope would be controlled by cool heads, but there seems to be fewer and fewer cool heads in charge. Meanwhile, the negotiations between Britain and its European partners seem to go on forever, but never seem to reach a conclusion. That's certainly acting as a drag not only on the British economy but also the European economies. Companies keep saying, well, look, we can't invest while there's all this uncertainty around the future trading arrangements. So all sorts of problems with the euro economy as a result of that. Meanwhile, as I say, populations which have been faced with austerity measures and huge inflows of mass migration, etc., have grown increasingly concerned about their own employment, their own health services, etc. And as a result of that, have turned to populist strongmen politicians, if you like, who are putting their own countries first and turning in on themselves as opposed to opening up to the rest of the world. And that's certainly a huge change. Really, since the Second World War, the trend has been to open up for an increase in free trade, for free movement of peoples across huge trading blocks, and now, of course, a number of new presidents and prime ministers, etc., trying to put that to an end. And of course, we've had this sequence of terrorist events impacting major European cities over the last few years. So against that backdrop, it's hardly surprising that New Zealand looks increasingly like the place that you want to be, doesn't it? We're geographically isolated from most of that chaos that is occurring in other major economies around the world. We've got political stability, we've got a really strong rule of law, and so investors in particular, as they look where they like to invest their money overseas, they can look at the Australasian markets and New Zealand, and they can say, well, look, we can, with a huge degree of confidence, decide to invest in New Zealand now, knowing that in 5-10 years' time, when we wish to withdraw our money from New Zealand, we'll be able to do so without political interference. And of course, New Zealand always ranks very highly on the ratings with regards to openness for doing business and the lack of corruption. So it's hardly surprising, is it, when you've got these huge international funds, property funds, superannuation funds, as they look around the world, they would select New Zealand as an area where, hey, we've got a really stable and secure platform there in which to invest. So that's become increasingly, we've become increasingly on the radar for these major groups. And I guess that's illustrated pretty clearly when we did an analysis of every commercial and industrial sale across New Zealand for the last 4.5 years. The minimum price was $20 million, and we looked to see who bought those properties. And as you can see from the pie chart, no research presentation is complete about the pie chart. As you can see from this particularly excellent one, very colourful, that overseas entities were responsible for around 50% of those high-ticket item properties. Of course, the most recent being the $635 million purchase of the 7 buildings in the Wynyard Quarter, which the Bailey's building is one by the American fund, the Blackstone Group. And they bought that at a yield of just 6.6%, incredibly low for a ticket item that high. And when you consider that the 7 buildings all sit on leasehold land, so they haven't even bought the land, it's even more incredible. So all they've done is bought themselves a presence in New Zealand, because it's top of the pops, and they've bought the cash flow from those buildings. Certainly looking to invest more money in New Zealand. So who else is buying? Well, the New Zealand listed funds, who are quite often active, have not been so active in the last few years. So that's your precincts, the Kiwi property groups, etc. The reason for that is that basically they've been the people selling property, and they've been selling property in order to fund their own developments, such as Commercial Bay down on the waterfront there. Other New Zealand entities, well, they've still got big chunks, actually limited companies, wealthy individuals, owner-occupiers, etc. They've carved out about 30% of themselves. And syndicated groups around the country, Oyster and Augusta, for example, are pretty active in that market there. So what that has resulted in, of course, is that there's a huge increase in competition from overseas and the traditional buyers of commercial property, the New Zealand entities facing this additional competition. Hardly surprising that we've seen yields being really compressed, and of course that's resulted in a kick-up in capital values, which is all fed into the returns that you can get from those commercial properties. And as I mentioned, the other attractive thing about those Australasian markets is that compared with many other leading economies around the world, the returns that you can get from institutional grade commercial property here are much higher than you can get in the countries from which that money is flowing. So from the United States, look, the average return from institutional grade commercial property in the States was about 8.6% over 3 years, whereas in New Zealand we've generated double-digit returns for a number of years now. The biggest investors in New Zealand over the last 4 years have been entities from Singapore. Hardly surprising to look at the return you can get from New Zealand. It's about twice that which you can get if they invest their money in their home country. So that just really sets a bit of a scene as to what's happening in in the commercial market. And we're seeing, of course, those lower yields being reflected right through the commercial markets, particularly in the major centres, Auckland being the prime one, of course, record low yields for not only institutional grade property, but also other investment property across all sectors. So that's enough of that. What about the residential market? Well, as we all know, the Auckland residential market has had this record run post the global financial crisis, and that was driven by a number of influences, a strongly performing economy, practically no inflation, record low interest rates, record high population growth, and housing shortage. And if we were standing here and just looking at these drivers, you'd say, well, hey, most of those are still in play, aren't they? They are, generally speaking, off their peak, but look, the economy has, despite the fact that we've seen this collapse, as they call it, in business confidence, the big numbers are all still pretty good, aren't they? We're still seeing GDP growth of 2.5%, and most economic commentators are saying that with the amount of money that the Labour-led government is going to pump into the economy over the next couple of years, then that sort of GDP growth is likely to be maintained, maybe even stepped up. On the other side, if business really is as nervous about things as those latest surveys would suggest, then we may see a further softening. But at the moment, the big number's still pretty good. Still practically no inflation in the economy, apart from one-offs like oil prices, which the Reserve Bank will look through. And as a result of that, the Reserve Bank is going to keep interest rates lower for longer. As you'll all have seen in the news, Mr. Orr, the boss of the Reserve Bank, he said that he can't see any reason for the OCR to now move up until the early part of 2020. And in fact, there's a lot more conversation, isn't there, about the next move in the OCR being down as opposed to up. So look, that low interest rate environment, which has meant that people have been able to finance ever more expensive property, is going to be with us for longer. We've still got population growth, migration off its peak, reached about 72,000 per annum not so long ago. It's still at about 65,000. If you look at the long-term average, it's about 18,000. So that's still hugely stimulatory for the economy and still putting a lot of pressure on a housing market, which, despite the fact that we've seen building consents increasing significantly over the last few years, still is suffering from a shortage and will suffer from a shortage for a number of years yet. So look, all of those, as we know, have been in play, and of course they've driven record value growth over the last few years, and we can see that hopefully on this little video of local sales. So the red dots, that's sales of over $1 million. The blue dots are sales of under 500,000. And you can see that each individual sale that's occurred since about 2001, I think, is popping up there. And the most obvious trend that we can see as we flip through to 2018 is, look, the blue dots are disappearing, the red dots are becoming ever more frequent. So we can see this shift in values within the local area here, which has followed those trends, and surprise, look, the waterfront suburbs are where the real value appreciation has been. So this is what we've had. As I say, most of the drivers that have propelled this sort of value growth over the last few years are still in play, albeit maybe just having come off their peak. So other things must have changed because, of course, as we know, the market has changed. And of course, the biggest influence has been the government, two major influences, the government and the banks. And of course, the view of the Labour-led government there, or the Winston-led government, whichever way you want to look at it, is that their view on the residential property market is completely different from that which the national-led government had over the previous few years. The national government were very hands-off, let the market do what the market wanted to do. The current government is saying, well, hold on now, because things have got completely out of kilter and we need to level the playing field, and we're going to do so using legislation. So clearly the big ticket item there is to introduce more affordable housing. So we're seeing money being pumped into the Kiwi Build scheme. They've got their eye on speculators, as they call us. We used to be investors, now we're speculators because we're all evil people. And what they've done to control us is they've extended that bright line test from 2 years to 5 years. And of course, foreigners, they were responsible for pushing up the prices in Auckland, and so they've got to go. And they'll be gone within 2 months. These were the stages that the Overseas Investment Amendment Act had to pass through, and you can see that it was one of the first things they introduced when they came to power back there, but it's taken actually just about 8-9 months to get to this stage where royal assent was given. So royal assent was given on the 22nd of August, and the legislation itself will become law 2 months later, so the 22nd of October. And then, unless you are in the fortunate position of being Kiwi, Australian, or from Singapore, you'll find it very difficult, if not impossible, to buy existing housing. You may well be able to buy into an apartment scheme off the plan, but upon completion of those buildings, you won't be able to occupy them. You'll only be able to lease them out. So some big changes afoot over the next couple of months. If you have a deal in the pipeline with an overseas buyer, as long as it's unconditional by then clearly that will be allowed to settle. But the clock ticking on the influence of overseas buyers. As I say, the other big influence has been banks and mortgage lending. Most of our banks here are Australian owned, as you know, and they've grown increasingly concerned over the last couple of years by the amount of money that they have lent to the residential property sector in Australia, and it's a huge proportion of their overall lendings. They've decided, hang on, we should throttle back on that, spread the risk a little bit, so they've tightened up on lending criteria in Australia, and of course we're just a suburb of Australia, so those same restrictions have flowed through here, and I don't need to tell you, you're speaking, I'm sure, to more potential purchasers who 2 years ago would have got finance quite easily, and now they're finding it far more difficult to obtain, and we're seeing more and more deals falling over on finance, aren't we? Look, here's some figures that show probably why. Look, the market was roaring, wasn't it, back in the middle part of 2016. The banks, over those 12 months to May 16, they lent $72 billion to residential borrowers. Look, the latest figures there, year to July this year, they've reduced their annual borrowings, lendings to 61 billion. So a significant decrease in the money that they're lending to residential purchasers. And look at the impact it's had on how the purchaser pie is made up. Investors, they've been hit particularly hard because, of course, they've got the LVR rules to deal with, 35% minimum deposit, etc., etc. So when the market was roaring away, they were buying 1 in every 3 buildings. Now, look, they're down to less than a quarter. So certainly, investors are far more on the sideline than they were back when the market was really roaring away. First home buyers, as a result of investors getting out of the way, have been able to increase their proportion of the pie, albeit a smaller pie, from 11.5% to 15.5%. And movers, so these are people downsizing, etc., have increased their share of the market. They're the largest part of the market by some considerable proportion, and that is, of course, because they are generally, when they're downsizing, etc., or moving around, they are less dependent on bank finance because they have equity already for their own use. So that's how the things are changing there. The big thing to keep an eye on is when will the banks start to loosen the purse strings again. So the impact of that has been that what we've seen is we've seen the Auckland market really return to its long-term sort of averages. What we've had over the last few years, of course, isn't a normal market. It's been an abnormal market driven by all those influences which we touched on earlier. So the best way to sort of see how things are going is to look at some of those longer term trends. So the blue line there, that's the total inventory available to the market across the whole of Auckland, and you can see the red line, that's the average inventory, which sits at just over 10,000 properties on the market. Look, when things were really roaring away, that had fallen to about just over 6,000 properties. So total inventory had squeezed down because sales were occurring so quickly. As a result of that, the weeks to sell the total inventory, so that's if you took all of the property that's on the market at any one given time, you stop taking new listings, you continue to sell at the same speed as you had done over the last few weeks, and you calculate how long it would take to sell the total inventory. Well, the long-term average for Auckland is about 22, 23 weeks. Back here, it squeezed down to just 9 weeks. So that's how tight the market was. Current levels look back towards those sort of longer-term averages. So what we're seeing really in Auckland is a more normal market if you look at that long-term trend, and we can certainly see that playing out here in the Hibiscus Coast, can't we? So the blue bars, that's the number of sales which complete on a quarterly basis. The black line is the median value of those sales, and you can see there that from sort of early 2012 right through to late 2017, we had this record increase in values, pushing the median up from about 450,000 right up to sort of 850, 870,000. What's happened over the last sort of year and a half, of course, is that those values have started to run sideways. We're not seeing that same appreciation in values, and that's as a result of the fact that we saw those sales activities coming off the peak and falling back again, as we say, probably towards those longer term norms. Good to see there's been a bit of kick up in activity early part of this year, albeit still off the highs that we enjoyed back in 2015, 2016. So if we look ahead, what do we expect? Well, let's look at history again and see what happens to Auckland house prices on a long term. So this is from the 1980s. And you can see that look, there's a definite trend there. Auckland has a bit of a run where we see an uplift in values, and then they'll run flat for a while, and that's normally as a result of some influence from overseas that impacts the New Zealand economy, quite often something that nobody predicts. So we picked out a few here: the 87 share market crash, the dot-com bust back there in the early 2000s, and of course more recently the global financial crisis. But you can see that Auckland very rarely has an oversupply of houses, so the market tends to correct itself fairly quickly, and we don't really see values falling away to any great extent. During these quieter times, values tend to run sideways. Only the GFC, the biggest adverse impact on the global economy since the 1930s, really saw the values dipping away. Look how quickly they recovered, and they've been followed, of course, by this historic run in value gain that we've seen over the last 4 or 5 years. So now you can see, as we've fed in the latest figures there, that again we're following those sort of longer term trends, and those values starting to run sideways, and they will continue to do so while the banks keep a lid on finance, until people actually see an increase in their wages, because property in Auckland is pretty unaffordable, so there's not a great deal of room for further increases in value. We can expect a softening in those migration figures if the Australian economy picks up and people start to leave to find better job prospects in Australia. Already started to see that come through a little while. So in the last few figures. So look, we can expect things to stay pretty much as they have been with regards to prices for a little while. But remember back to those big drivers: the economy, the housing shortage, still well above average migration. So values as they are continue to be very well supported. And yes, there will be quarterly, half-yearly fluctuations as you see the figures. But generally speaking, things expected to run sideways over the next few months. And that's it.
Okay, well, thank you very much, Ian, for your time.